alternative strategies with Nina Vos, together with her first panel in the morning, Milen Ivanov, managing partner at Sophia Angel Ventures, Alexandra Laska, partner at Red Alpine, Stephen Pauls, founder and CEO of Moonfair, and Helena Torras, Hans Woman.
So, thank you everyone for joining us on stage and for joining me in this conversation. Logistics, your mics are here, there is water. If you need anything else, please let me know, because the team is for sure happy to help us. And in order to get us started here, and to make sure that the audience is also familiar with the people that are going to be involved in this conversation now, I would ask you, starting with Steffen, to introduce yourself quickly, to mention what stage you are investing in and what type of investments you are doing in your daily business, because that's what we will be discussing for the next 45 minutes. Please.
Yeah, wonderful, and thanks first of all for having us today. So my name is Steffen Pauwitz. I'm the founder and CEO of Moonfair, and what Moonfair does is pretty simple. It opens up private equity, venture capital, growth capital to private individuals. So to your question, we are opening up various asset classes, investing across all cycles and strategies. And in Austria, you can access the platform and can start investing with as little as 50,000 euros.
Thank you.
So thank you very much for inviting me. I'm Helena Torras, I'm from Spain, and I've been an entrepreneur, and now I'm investing for Hansi Hansman, for Hans Women Group in the South Europe.
Good morning, my name is Alex. I'm a partner at Red Alpine, which is a venture capital fund based out of Zurich, and we invest in tech startups at seed and Series A stage. We've been around for 16 years, which is a bit of a dinosaur in European terms, and I'm looking forward to this discussion.
Thank you.
My name is Milen Ivanov. I'm managing partner at Sophia Angels Ventures. We are a co-investment fund that invests alongside angels, family offices, corporates, and private VCs. We have a mandate by EIF for 5 years to invest this 13 million and match private capital investments. Our stages pre-seed and seed level, we invest from 200 to 500K in scalable technologies companies, not only from Southeast Europe, but also throughout all EU.
Thank you. And to make sure that also the panel has an idea about who is in the room, I would ask for a show of hands who is actively investing in Europe, regardless what type of investments you are doing. Okay, very nice. Thank you for sharing that, because that also helps us in sharing our learnings and best practices. So looking back basically at the last 2 years, or probably 10 years, we look back at the time of boom, of exits, of new unicorns entering the European tech arena, of raising mega rounds that were almost a little bit scary looking at from the sidelines. And yeah, this level of scariness is hitting us now, as we also see in the numbers that have been published recently about the European funding landscape, where we look at a drop of 44% of VC and PE money that has been invested in Europe in Q3 of this year. In comparison to last year. So what does this mean, and what does this mean in like numbers for specific regions and stages? And in order to put this also into perspective and make sure it's not only doom and gloom we are looking at and discussing today, I have asked our panelists to bring along some numbers themselves, as we investors always love looking at numbers and putting them into perspective for their respective stage. And with this, I would actually start with Steffen again, as he is basically coming from the LP side, and there are quite a lot of GPs also in the room today. So Steffen, when you look at investment activity of big fund of funds and institutions investing then in PE and VC VC funds. What are the recent trends that you and your team are seeing, and are there already some implications that you would want to share with the crowd today?
Yeah, look, happy to. I think we have to differentiate between 4 different buckets, call it. One is, of course, what happens on the portfolio side, and there a lot of challenges are ahead of the industry. Then we talked about fundraising, and I will come back to this in a sec. Then, of course, what does it mean and what is the impact in terms of investing? And then what is the exit, how the exit markets look like? If I may talk about fundraising, we saw this from Ingo in the keynote in the beginning. The GPs are still sitting on piles of cash. And fundraising environment is more challenging. I would call it, it's more differentiated for most of the GPs. But if you see, for instance, in the buyout segment, if you take latest fundraisings, EQT, for instance, largest fund ever, first close 15 billion, CDNR and others. So fundraising is still astonishingly, and I'll come back to this in a sec, intact, but it takes longer. And why is it intact? And that's important to understand. People have learned from the past. And this is one point that makes me very positive about this crisis, because most of the managers and also LPs that are still in charge today have seen financial crisis and have learned out of the mistakes made. Post-financial crisis, if I may state this for a sec, and I've been with KKR in these days, the industry basically stopped investing. It was like in a shock. And the only one, or only ones that are, at least in the buyout segment, if I may take this example, that were actively investing were Blackstone and Apollo. And there's a very interesting phenomenon at post-financial crisis, 2008-9, KKR, Apollo, and Blackstone were more or less on the same level. Blackstone went long, Apollo did the same, by the way, and today there is a huge gap in terms of assets under management and success also between those two. So the industry has learned. That means when we talk to GPs as an LP, we see they are in very, very positive mood. We see the contractions finally in valuations, not yet there. This is why currently the investing activity has slowed down. But looking forward for the next year, the industry is very, very positive. And we all know from past data, if there's a time to invest in venture growth and private equity, it's now. The best vintages we've seen, 08, 09. Best vintage we have seen post 9/11, 96. So the current recession offers a huge opportunity for the GPs, and smart LPs know this and go long.
That's very good news indeed. So looking at the GPs and active investors that are also now on stage with me, starting with you, Alexandra, how is your experience also in deploying money and in the recent activities that you've seen, especially in the deal-making process nowadays?
So firstly, I think that it's very difficult to do a year-on-year comparison because, as you mentioned, the last years have been pretty extraordinary. And in fact, I call this normalization rather than a complete drop in the market. And I think the last years have not been sustainable, to be honest. And I'm actually quite positive about what's to come because I think we will see better deal flow, higher caliber. We already see it now. Summer season was a bit quiet, as usually is. But September onwards, we've seen a huge inflow of very interesting, strong teams. On the early stage side, of course, because this is our focus. The drop in investment was predominantly in the growth or later stage. So on the early stage, we still see very compelling for founders valuations and round sizes. And I think that VC funds going forward will probably focus more opportunistically on downside protection and better terms. But I'm very positive that the early stage deals will continue to go strong. I do agree that VC funds will become more picky. There is a flight to quality. I think there is a huge interest or focus on route to profitability rather than growth at any cost, extending runways for existing portfolio companies. But as you mentioned as well, I mean, during the last crisis, 2008 financial crisis, the likes of Airbnb and WhatsApp were founded. Cisco got their initial seed ticket a few weeks after the Black Monday. So I do actually believe that this is a very exciting time for VCs to invest in sustainable business models with a very significant tech hedge and product differentiation. I think these are the key things we've been doing for the last 16 years, but I think more than ever before, this is a very important aspect to look at when you consider an investment.
Thank you. So, Milan, what do you see in your daily business in your region?
Yeah, I know this is a panel for crisis, so I try to be more positive here because for Southeast Europe, the first half of this year has been record high in terms of venture capital investing. It's close to 2 billion. And in terms of enterprise value increase, it's like 5 or 6 times, which is much better than the average of Europe, which is 3.3. And of course, it's starting from a lower base, but still there is a lot of opportunity to grow just because the market is emerging with these aspects. So there is this data that the venture capital investments in this region are only 20 euro per capita compared to 115 in DACH region, and in the Baltics they have tremendous numbers like 200,000 200 per capita, which means there's a lot of room to grow. Of course, people are a bit gloomy with the situation because the inflation is very high, it's close to 20% on average. In my country, in Bulgaria, it's around 13, but everybody knows that it's much more. And people have kind of forgotten about COVID, and now they're worried about the war in Ukraine and the rise in energy prices. But the recession is still not quite there. We kind of know that it will kick in, winter is coming, and then the consumers will feel it, and maybe the businesses that are oriented with this aspect will feel it too. But the investors are kind of, okay, slow down, they decrease the tickets, but they're still investing in early stage because there's a lot of capital from before. There are some government funds that have been backed up by EF and the national governments that have mandates, they have to invest the money, and they were driving the valuations like crazy. And now what's happening, they're sobering up, which is good for those that are careful with valuations like us. And yeah, we're positive in terms of opportunities. Of course, we are worried of what can happen because we are very close to the war, and we feel it physically, not like only on TV.
Yeah, that's definitely an important aspect to look at, and something that we also see reflected in the inquiries we receive in our daily business from working with startups from all over Europe. So also then handing over to you, Helena, as you are usually among the first investors. If we look at startups, what are the questions that you are facing nowadays as a very early stage investor, and what are also the highlights and lowlights that you might have encountered in the past weeks and months?
Yeah, so thank you. I would repeat everything that my colleagues have said because I couldn't agree more. But it's true, we are very positive. Now there is a massive deal flow, really, more than ever. I will talk about Spain. We are already on the second-time entrepreneurs who are launching startups. So I would not say we are mature yet, but we are on the process to do it. Last year, we raised in funding rounds more than 4,000 millions versus 2020, which was 1,000 million. And so far this year, just in the first semester, we have done more than 2,000 million. So there is movement, and when you are there, you want to stop it even if there is a crisis, because when there's a crisis, there is even more deal flow. There are even more projects starting. There are even more entrepreneurs wanting to launch new ideas, and that's the best moment. So there is really, really massive deal flow, but so when we talk about Spain, even before winter had come, we already had smaller tickets. When we are talking about valuations are decreasing. Valuations are decreasing because the tickets are decreasing. It's not because, in fact, the value of the company, but because we are investing less money. So when we are talking about Spain, our pre-seed or our seed stage is quite different of what your pre-seed or seed stage mean. So usually it's a zero less than yours, so we were small. And now we have so much opportunities because I don't like the word cheap, but it's cheap to invest there. You can go in really amazing startups that will be really capital efficient because they know they will not get funding, and especially when you are investing in these startups, you are telling, if with the money we will give you, you have to be 18 to 24 months with that. Maybe you need the money before because we want to go big, because we want you to go faster. That will be, but if not, you have to be sustainable. And I think that's the difference. Maybe before we were, okay, if you need money in 1 year, we wanted a profitable business, but it's okay. And also the question is, for what will you need the money? So for this growth, what will this mean? Is for marketing, so it's a business that only will grow if you invest in marketing, or the money we will put for growth is for expansion, is for going to other countries, but it's not only marketing based. And I think this really is a huge difference because it's changing also the kind of projects you are financing.
Yeah, that actually ties into my next question that I would address to the investors who are directly investing into the targets here on stage. Basically the implications on the one hand for your day-to-day portfolio work that you're seeing, because also like basically at the target level we are seeing rising salaries which are just necessary to reflect inflation and rising energy prices and so forth. So there is actually on the one hand, most likely a higher burn rate versus maybe spending less on marketing, etc. But on your board work especially, and on your day-to-day interactions with the founding teams you are working with, what did change? Because my impression from talking to investors is that there have been quite some, I would say, strategy meetings to also adapt your operational work. Is there insights that you can share also with the group? And maybe also for the discussions then in the coffee break, because I would be surprised to hear that everything is just as it always has been. Has it? Who would like to take it?
Happy to jump in. When the crisis really started, you know, the first thing we got on our table from the Sequoias, from the Kleiner Perkins, were decks for their portfolio companies saying, if you don't adapt to the new reality, you will not survive. So there is no more of the same, and let's continue as is. What you have to do is, and stating the obvious, you have to, of course, optimize for cash. It's a zero-based budgeting approach, really asking yourself, is this absolutely needed? The second, what you need, and we are seeing, by the way, already quite a few layoffs, and there's more to come as people prepare. The second thing, what you have to make sure, and that was already stated here on the panel, is make sure that your runway is sufficient. Because in the current environment, people would face down rounds, or they would be facing, you know, liquidity preference or structured notes. And with all means, you have to avoid this. And when we talk about run rate, it's not about 12 months, 18 months. The advice from the largest investors, tech investors in the world, is you should prepare more for 36, 48 months. If you can still raise money, even if it's at the current valuation, and get more money into the door. And then please be prepared that the times will not come back anytime soon. This is an important point because we are all in a way, you know, spoiled by what we've seen in the post-COVID. Yeah, the V-shaped recovery, this is very different, this crisis. We are facing here very different from the financial crisis. It's not a demand crisis, it's a supply crisis. Demand you can fix with governmental spending and with central bank intervention. Supply, that takes longer because we have broken supply chains. So the current recession will last, and this is the core message. Prepare yourself for a longer period of time, and this is nothing that can be cured in the next 12 months.
So what I would add to that is that with every crisis comes an opportunity. So we've also seen a few startups who are lucky enough to be in that leadership position in the market, taking advantage of the consolidation in the market. Also acquisition of top talent is a lot easier. The last 2 years have seen, you know, I mean, it was a very difficult task to find good people at startup prices. That's a lot easier now. So I think these 2 points are very important because that's sort of the consequence of what's happening in the market now. I think extension of runway is extremely important, and we spend a lot of time looking specifically at how we can extend runways for our portfolios. Having said that, those companies that have shown really great growth rates and can raise, even though they don't need to because they do have enough runway, we encourage them to do so, just to have this additional cushioning and leverage the first 2 points I mentioned of the market dynamics, which with more cash obviously is easier. I think topics such as internationalization have to be really thought out very carefully. Maybe not the best time to do it aggressively or as aggressively as in the past. But what I always say, and it's easier said than done, is extend your runway without compromising growth too much. Because, as we said before, obviously there's a lot of dry powder. In fact, we have probably 5 times more dry powder in the market than we had 5 years ago. So on a long-term basis, we're actually in a really good spot. So there is money to be raised, but you have to show something for it, and you have to show milestone achievements. And without that, it will be very difficult to raise a up round or a reasonable round for you as a founder. So these are the things that we advise our companies to look into, and we work very closely with them because obviously at early stage, we're also very involved investors. So yeah.
I think building on that, I think we have to differentiate growth stage that precedes seed and early. I mean, for a pre-seed round, if you wait 36 months, you are getting so slow. You need cash to speed up and to consolidate your position, and that there are not others taking your place. So although there might not be so easy the money, there is money. There are a lot of people investing, taking more time to invest, investing less money, but they are investing. So although we are asking the companies to have a sustainable business, we are not saying they have to be only sustainable, they have to bet for growth. So this balance, it's difficult, but we cannot wait and grow organically and slowly for 36 months. This is not startup. We want exponential growth. And for this, usually you need money. And if you are good, you have good metrics, you have proven, you will find it because there is money outside.
And for us, it's pretty much the same, but try to add a few things. There was one company that actually was experiencing supply chain issues, just because of the situation, more from COVID times, but also from the war with Ukraine. And there was one company that was experiencing issues with closing of a market, Ukraine, so they were planning to sell some agri-tech there, which is a big market. So these things are affecting us, but in general, I think the biggest problem for at least Southeast Europe is the increase of price of good talent. Because of the inflation, because of the rising prices, because of everything else, and the competition from the multinationals, and also US startups setting headquarters in Bulgaria or Macedonia or Romania, the salaries level have risen up, and that makes it very difficult for a local startup to compete in terms of attracting and retaining talent, which will, I don't know what will happen when the recession kicks in, but probably it will not get any better.
So basically there is also a certain time lag that you're seeing in your region in comparison to maybe hubs like London, Paris, like the dynamics there in hiring, pricing of talent. So we just heard it's easier to find talent in some region and for some companies now, whereas you mentioned basically the international competition and the headquarters that are coming more and more also to your region.
Yeah, that's actually the effect of this, because everybody was coming there to hire cheap talent, but they started little by little to become pretentious, and they were selling themselves, I mean, the talent to all over the world. And okay, naturally they were taking salaries similar to the Western world, especially for tech talent. And now the startups are experiencing great difficulties to attract this kind of talent when they start to grow. Of course, the founding team and the first employees are easy to get and inspire, but after 1 or 2 years, that's the issue that they're facing.
Mm-hmm. Makes sense, yeah.
I think it's also important for startups to not be afraid to charge their own customers in line with inflation. I think it's almost expected in these markets, and I think that helps a little bit also, down the line with paying higher salaries in line with inflation.
Yeah, that leads me actually to my next question, which is around business models and how you assess different business models nowadays, because we have seen a lot of businesses that were basically focusing on growth, acquiring customers, charging nothing or close to nothing, depending on what they were selling. So how do you look at these models today, and what are the I would say the key factors that come into your decision making nowadays when you assess business models and various market expansion approaches?
I always hated freemium models, to be honest, as an investor. Sorry, please.
What I can say on this is that we are very much focused now on profitability. So what we're trying to do when we are assessing a company and also when we are investing in it, to make a very deep financial due diligence on their business model, on how they make money. If they calculate the cost of goods sold in the right way, so they have the right gross margin. And we are trying to place more focus on that rather than on growth. I'm not saying that we're not interested in growth, but we are not interested in growth just for the sake of it at the moment, because they reach very soon this phase where they will have to show this kind of potential for being profitable, and I think this is the biggest change. So I mean, profitability and making money is much more important than the growth potential, and hence these freemium models are becoming kind of obsolete in many directions.
If I may add to this, there is a famous quote from one of the founders of one of the largest tech investors in the world. And he said, I've been working with my directors and principals over the past 10 years, but I still don't know whether they are good investors. And now really is the time to differentiate. And what we are seeing in data is interesting and goes exactly into your direction, is there's this famous, and many people are familiar with it, rule of 40. Rule of 40 is the combination of your profit margin and your growth. Yeah, and that has to be above 40. And the more you are above 40, in a better place you are. And what we are seeing in the data is that valuations contracted massively in the non-rule of 40 segment. And if you are a company that fulfills the rule of 40, you still have a very good chance to get decent funding. Is a wonderful time, not at the valuation levels, of course, from yesterday. In Q4, to give you two stats, which I found interesting, Q4 last year, forward-looking revenue valuations were on average at 44x, 44 times. This has contracted now for the best companies to 18 times on average, and best is in the rule of 40. So there is the hunting ground for any investor now. Cheaper valuations. In my view, they will come back not to 44, but over 18, and companies that really deserve funding.
To add a different perspective, which I agree with them, but just to be different, we focus a lot on trying to have recurrent revenue and be fully scalable with a tech base, so you don't need to invest on cost of goods to get more profitability. So there is where we think there is a huge opportunity, and we have really huge and great talent here in Europe. And maybe we are not betting enough for them, so we need to invest more there, just claiming to put money in this innovation and these startups, because really we have excellent people here. So scalable projects with recurrent revenue, because then once you have the customer, I mean, it's easy to keep them, it's easier to recover if they leave and everything. Getting a new customer is where you have the problem. That's why I said also, I mentioned before, that it depends on what you want money for. If it's for marketing for attracting new customers, that will be because you will depend always on this money. You need to get the customers organically or because they just come back. So, yeah.
The only thing I would add that at early stage, I mean, it's very hard to invest already in a profitable business. Very often they're not yet profitable, but you have to understand the route to profitability, in what timeline it will happen and how they will achieve it, and whether the assumptions are reasonable and rational, especially in today's macroeconomic climate. The other thing that I would say is, even when you do pilots in a B2B business model, let's say, it's quite easy to get a free pilot or a pilot for 500 euros from a huge conglomerate. It's pocket money for them. So what I always look at or try to look at, and this is from my times when I was also operationally active in a startup myself, is that it's a significant enough number that there's commitment from the customer as well to convert, and that they will throw the resources and people at it to make it work. So when I look at pilots, which is often the only thing a startup has at seed stage, I always look at what are the pilots worth, because it's a very strong indication of how big a problem they're actually solving for these companies.
Just to mention one thing on that, because one of my favorite metrics is looking at the cohorts, which means, you know, how long the people stay using your tool for each week. And it's different from the daily active users and monthly active users, because at the end, if you have some users engaged that they really use it every day, every week, I mean, they will pay for that and they will keep there. So for me, I agree, this is one of my favorites. And the other thing, it's true what you're mentioning at the beginning, you know, the metrics show maybe a trend, but the real challenge is not selling 20K a month or 50K a month, but it comes when you have to do 1 million every month. That's the real challenge, and you don't know when you're investing at really seed stage, but you have to see if the team and, you know, the foundations they are building will make it viable to do it.
Amazing. So we have roughly 10, 12 minutes left in our discussion, which I would want to use also for M&A and exit projections that you for sure have made in your teams and for your portfolio. That's of course always like reading a little bit like in the dust or in a dark room, but still there is on the one hand experience from previous crises and also basically industry feedback that you're receiving. Looking at your current portfolios and also the funds that are being raised right now, what are the biggest changes that you see for the next 3 to 5 years in potential M&A, exit, and maybe even IPO scenarios, if they still exist? I don't know.
Yeah, maybe quickly on the chances. And look, one of the mistakes of the past has been in the past 10 years that business models got, you know, number 2, number 3, number 4 in a segment and not the category leader. They all got money. This money is now stopping. And the great chance for, you know, number 1 and number 2 is, of course, consolidation. And there are many subscale businesses that will not get any more funding, which is great, and which is another reason to invest into venture and private equity now. They will not get funding, so what's going to happen is that you know, there will be consolidation plays. That's one thing, and one important theme. On the exit side, of course, you know, when it comes to late stage exits, IPO markets are down. This is not forever. You know, this famous SPAC phenomenon. I'll give you one stat, which I find interesting. 98% of all SPACs are expiring. So no deal. So the public markets are probably closed down for the next 12, 18 months. But we should not forget that corporates are sitting on record levels of cash. Yeah, they have all very strong balance sheets. So I would expect that corporates become more active in M&A, also in the venture and tech area. So there will be also exits plus consolidation.
Thank you.
That's what I think for my region is going to be very realistic, that their acquisition from strategic buyers, I mean, we don't have a lot of IPOs, if any. So that's in 3 to 4 years when we will start to have to sell our companies. I think that the market will be in the right place. Of course, if the companies we invest in strategically conquer markets that are interesting for those guys, because most of the people that are starting some kind of business, they kind of have this vision just to copy somebody and just enter markets where we don't have a leader yet there in this market and sell it to them, which rarely works. So the ones that actually can deliver an exit to the investors are those that start from day one to think about the DACH market, to think about the Western Europe and US, and that's what we want to encourage so they can become sellable.
Thank you.
Okay, so I will tell you a little bit about Spain. In 2021, we had 68 exits, and in 2022, so far, 52. And also, we have had some over 1,000 million. If you go to the average, it's around 100 million. And also, I would say, now it's not the best time to sell. When you are talking about these sizes, usually it's not a cash operation, it's exchange of shares. So this is easier or more likely to happen than when you have to put cash over the table. So I think if you really want a cash operation in the near future, that's not the right moment right now. But if you want a strategic operation where you can grow with another partner and there is exchange of shares, I mean, there is need for consolidation, as was mentioned, and probably, I guess, in 2-3 years, we will have more opportunities for cash operations.
I think big corporates who might be the acquirer in this case are also becoming or are already very cost sensitive, of course, with what's happening in the markets. And therefore, they are also looking for solutions, also within the tech and innovation space, to some of their problems. So I think companies that help with, efficiencies and costs will have a great chance to be a potential target. And we have seen in our portfolio quite a few approaches actually from big players in the market who, quite frankly, are probably also hoping for you call it in German, Schnäppchen, a good deal, let's say, in those times. So I think on that path of exit, there are a lot of opportunities that we can leverage right now. On the IPO side, I think anyone who probably wanted to aspire to do one this or next year will hold off if they can. But thereafter, as you say, the market will have to pick up because there's just too much money in the market to just leave it sitting, and it has to be deployed.
If I may quickly, if I want to, can add to this. I've been investing in tech since '96, and I'm hearing, or I heard every time when there was a crisis, 9/11, so 2001, 2008, 9, and now again, tech is dead. That's the biggest mistakes. If you read the data, the contrary is true. Tech emerges stronger out of each crisis, each one that we have seen, than ever before. And there's another stat that I want to share. Currently, we all say maybe this trend comes to an end, but so far, in terms of global GDP, and we are talking about 30 trillion, only 10%, 3 trillion is the market cap of all tech companies together, has been disrupted. And if you talk to all experts, they all say this number, this disruption number of 10% over the next, 5, 7, maybe 10 years goes up to 40%. So we are seeing a 4x need in funding and a 4x need in opportunities. And this is why I'm convinced, and this is one of the big themes at Moonfair, our investors, they go long in tech and growth.
Yeah, I mean, honestly, I totally agree. Tech is dead is kind of a contrarian view I would not subscribe to. I mean, also looking at the big issues that all of us are facing in the various industries that we are investing in. I mean, starting at climate, moving over to health. There are so many issues that most likely will only be solved with tech and by tech. So I hope that European investors and founders especially will double down on that, because otherwise there's going to be quite some difficult times ahead. Yeah, with this positive note, I would actually start the very last round, moving closer to the end of our discussion, asking each of you to share one either insight or learning that we have not discussed yet that you think might be relevant for especially the investors in the room. Can be either on the vertical that you're interested in or also the stage or the region when considering investing and the outlook of investing in Europe in the next 12 months.
I'll be very direct. We have to keep on going. Just participate and follow what's going on. Maybe, with smaller tickets, more careful, negotiate hardly the valuations, and just chip in. So there will be better times. Yeah, in at least 1 or 2 years, but there will be better times.
Thanks.
So I'll say something slightly different. On a more human level, all numbers out of the equation, I think it's very important that we support our entrepreneur in exactly those times. In good times, the investors who have tried to squeeze for every penny will be remembered, and we're here for the long term, so it's important to maintain that good relationship with the tech ecosystem, and obviously you have to bring a return for your LPs, and therefore have to make intelligent investment decisions. But when you negotiate terms with the founders, think long term and not short term.
Couldn't agree more. Let's do win-win, because at the end we really win all together. So you were saying tech is dead. I couldn't stand talking about that. Tech is not dead. At least in Spain, is the only industry that is growing employment at 2-digit growth. So this means something. We really need people there. So the companies are growing. And yeah, support entrepreneurs. The best opportunities are now, really, the investors who invest on crisis and the founders that are born in crisis, and to be the most profitable, the better startups. So now is the time to put money in there, support them with a really friendly relationship, because on the long term you will have returns.
Look, fully supportive in terms of what has been said. Another point that I want to underline, and I said it, the past 10 years, or more or less every fund made 2x. This time is over, so manager selection and finding the right managers that are equipped to weather to capture the opportunities ahead of us, it's key. It's not anymore an index, it's really finding the right GPs, and that's an art.
So thank you, everyone. A big round of applause for this great panel, and yeah, thank you for joining.
Yeah, thank you all for your insights, and also for putting the current situation in a quite positive mood.